In today's video, I want to talk about the Roth IRA. Now, this is a tool that's been around for 20 years, but if you understand it from a wealth planning perspective, it can really be a powerful tool to help you out. So let's dig in. Okay, so what I want to do is I want to kind of go through some of the characteristics of a Roth IRA, but I think if we kind of compare it with a regular IRA, it'll help kind of show some context around the differences. All right, so for those of you may or may not be familiar, we've got IRA and Roth IRA. Okay, I want to point something out initially. These are just types of accounts. Sometimes I get questions from clients or prospective clients and say, oh, what does your IRA pay? And I'm kind of surprised by that question because it all depends on what kind of investments you put in that account. So they're a type of account, they're not an investment, okay? Or a type of investment. All right, so when we have an IRA, we've got to get money into it. That's a contribution, all right? So contributions to a traditional IRA are deductible, okay? Contributions to a Roth are not deductible, they're made after tax. And we'll take a look at why that's important here in a minute. All right, so the second thing that we want to look at is how does the growth of the account, the growth in the earnings, how is that taxed? So in this case, growth and earnings in the account are deferred until you take it out. And, you know, essentially it's the same over here with the Roth IRA. Transactions that are done every year along the way are not taxable events. Okay, now here's where the difference happens. When you start taking distributions or withdrawals from one of these accounts, here's the difference. This is a taxable distribution, and the Roth is the beautiful tax-free. Okay? So some things to consider when we're looking at this is what are tax rates now? Does it make sense to pay taxes now or in the future? And there's some other variables that are tied to that. But let's take a look first at the contribution limits. So in a traditional IRA, you can put in $6,000 per year. This is as of 2021. Now that's actually the same limits. This is the maximum that you can put in. And if you're over 50, you get a nice little bonus. You can put in an extra 1,000, so your total comes to 7,000. Okay? In retrospect, these two are the same. Now, to make these contributions, there's certain income limits or eligibility, if you will. Now, in the case of the, I'll just put it like this. In the case of the traditional IRA, 76, I'll just put these numbers down. I think is it 125? Okay, so if you're single or if you're married filing jointly, these are the income limits for deductibility of a traditional IRA. If you're single and you make over $76,000, you can't deduct your IRA contribution. If you're married and your combined income is over $125,000, you can't deduct an IRA contribution. Over here on the Roth side, if you're single and you make over $140,000, or you're married and you make over $208,000, this is eligibility, okay? All right, so I scribble off the edge there, but this isn't a deduction calculation. This is whether you're eligible. If you make more than this, you can't put money into a Roth IRA. If you're married, you make over $208,000, you can't contribute straight up this $6,000 or $7,000 to a Roth IRA. We'll show you some other techniques that we have that you can do certain things to make these contributions if you're above these limits. But as far as standard deductibility and eligibility, these are the numbers, okay? Now, so we know the difference about the contributions and the growth, but let's talk about, there's really three characteristics that I want to dig into. The first is contributions. All right. The second is conversions. All right. And the third is earnings. A contribution to a Roth IRA is basically the principal that you put in. That money can come out at any time with no penalty and no age restrictions. So no 59 and a half and no 10%. Okay, now this is a tax and this is age. Okay, so if you take money out of a regular IRA, okay, at any time, you're going to get hit with, anytime before 59 and a half, it's going to be ordinary income, so whatever your tax bracket is that year, plus a 10% penalty, okay? So the next is conversions. So let's say you have money in an old 401k or an IRA, for example, a rollover IRA, or maybe you've accumulated assets in a traditional IRA, okay? And you want to convert that over into a Roth IRA. Now, when you do this, you basically have to pay the toll to get on this sort of tax-free highway, okay? So this conversion has a different taxability characteristic, if you will, than a contribution does. But there's something that's called a 5-year holding period or 5-year window, if you will. The conversions that are made, the clock starts, and if you hold it for 5 years, you can actually take that money out without any penalty, 10% penalty, if you're before 59 and a half, okay? So what happens, what's interesting is that you can establish a Roth IRA, and you can actually start that 5-year clock window immediately. And in the future, if you do a conversion, each conversion actually has its own 5-year holding period to it, okay? But let me give you an example. I'll probably clear it up here. Let's just say you put $6,000 into a Roth IRA. And in that same year, you convert $10,000 from a traditional IRA into a Roth, okay? Fast forward a year, that $6,000 that you put in as a contribution, you could take that out. No ordinary income tax, no 10% penalty. That 10% conversion that you did from IRA to Roth, after 1 year, if you took it out, you'd have to pay 10% tax and ordinary income, okay, if you're before 59 and a half. I'm actually just going to add ordinary income up here because, okay, ordinary income tax. Now, I add that because if 59 and a half, if you haven't met that requirement, this is the tax that you pay. Okay, so the conversion has a 5-year window. So in our example, we talked about what would happen after year 1 with the contribution and the conversion. Let's fast forward now. After a full 5 years, you're now in the 6th year. We know that the contribution you can take out, no tax, but now that conversion you can take out. So now $16,000 you can take out without ordinary income tax or without 10% penalty. Okay, now that brings us to our third point, the earnings. Okay, the earnings, they give you a free ride here. You can take it out for retirement, and no matter how big this gets, you're not going to have to pay taxes. There's one catch: you got to be 59 and a half. Okay, if you take the earnings out before 59 and a half, it doesn't matter the holding period or anything like that. You got to get to that hurdle, otherwise it's going to be ordinary income, and you're going to pay a 10% penalty. Okay. There are a few exceptions in there to these rules. Some medical related, death, disability. There's one in there if you buy a first-time home buyer, you can take up to $10,000 early without that 10% penalty, but you're still going to have to pay ordinary income tax on it. But here's the thing. There's a lot of variables that go into this. Interest rates now, interest rates later. Rate of return that you're getting now, or maybe that you're getting in retirement. What is your income now versus your projected income in retirement? But fear not. No matter how complex this might seem, we have a system and a process where we can analyze, your current situation, and we can find out which of these makes sense. Sometimes it's full contribution, sometimes it's a conversion, sometimes it's a combination of the two. Everybody's got a different situation, but understanding this and really especially with what's going on with taxes can be a very powerful wealth planning tool. So thanks for sticking with us on this video. If you liked it, please hit subscribe, and we'd love to hear your comments.